Hello and welcome. Today we are going to explore something really fascinating, the volume profile visible range indicator. We are going to break down everything you need to know about it, and by the end, you will be able to use it to build a powerful trading strategy. By following along, you will learn how to read the volume profile, identify important price levels, and use this knowledge to make more informed trading decisions. Are you ready to dive in? Let us start by diving into why this tool is a game changer for traders. Imagine having a tool that allows you to see exactly where buyers and sellers are most active, pinpointing the spots where price is most likely to pause, reverse, or break out. That is exactly what the volume profile visible range indicator does. It shows you how much volume has been traded at each price level based on the visible portion of the chart, giving you powerful insights into key support and resistance zones. In simple words, it tells you where most of the buying and selling has happened, making it easier for you to anticipate where the next big move might be. By understanding where most buyers and sellers are engaged, you can identify potential breakouts, reversals, or continuation trends with much greater confidence. This tool not only reveals important market levels, but also helps you plan your trades more effectively, turning what might seem like random price action into a more predictable pattern. Now, let us expand on some key chart patterns that are commonly seen when using the volume profile. One of the most well-known patterns is the double top or double bottom. A double top occurs when the price reaches a high level twice but cannot break through, signaling a potential reversal. When this happens near a high volume node, it makes the pattern even more powerful because it means there is a lot of resistance at that level. A double bottom is the opposite, where price hits a low level twice without breaking below, indicating that a reversal to the upside might be coming. Again, if this happens near a high volume node, it is a stronger signal because many buyers are stepping in to support the price. Another important chart pattern to watch is the head and shoulders pattern. This pattern typically signals a reversal of an uptrend and consists of three peaks, with the middle peak being the highest. When the right shoulder forms and the price starts to break down, especially near a high volume node, it is a strong indication that the uptrend is ending and a downtrend might begin. The inverse head and shoulders pattern signals the opposite, often marking the end of a downtrend and the beginning of an uptrend. Watching how these patterns interact with high volume and low volume nodes can give you a better understanding of where price is likely to go next. We also have continuation patterns like flags and pennants. These are small consolidations that occur during a strong trend, and they usually indicate that the trend will continue in the same direction. If you see a flag or pennant forming in an uptrend, and it occurs near a high volume node, it means that traders are accumulating positions, and the trend is likely to continue upwards. The same goes for downtrends. Low volume areas can also provide clues here. If price breaks out of a flag or pennant into a low volume node, it often moves quickly because there is little resistance. Triangles are another significant chart pattern to be aware of. There are ascending triangles, descending triangles, and symmetrical triangles. An ascending triangle forms when there is a horizontal resistance level and rising support, indicating that buyers are gaining strength. When price breaks above the resistance, especially near a high volume area, it is a strong signal for a breakout. A descending triangle, on the other hand, has a horizontal support level and falling resistance, indicating that sellers are gaining control. A break below support can lead to a strong downward move. Symmetrical triangles indicate that the market is undecided and the price could break out in either direction. Watching volume levels during these breakouts can help confirm the move. Finally, let us talk about the concept of consolidation and accumulation. When price moves sideways for a prolonged period, it is called consolidation. During consolidation, if you notice high volume nodes, it suggests that many traders are positioning themselves, waiting for a significant move. Once price breaks out of this consolidation, it often leads to a strong trend in the direction of the breakout. Accumulation, on the other hand, happens when price is slowly moving upwards with steady volume. This can be an early sign that buyers are getting ready to push the price higher. Understanding these patterns alongside the volume profile can give you an even clearer picture of what is happening in the market and where opportunities may lie. Now, let us look at the different parts of the volume profile visible range in more detail. The first key piece is called the point of control. This is the price level with the highest amount of trading activity. The point of control is important because it is the level where most buyers and sellers interacted, and it often represents a balance point in the market. This level often works as either a support or resistance, and it is an area where price is likely to react significantly. When price approaches the point of control, it often experiences a pause or reversal, as it is a major level where buying and selling activity has previously peaked. Then we have something called the value area. The value area represents the range of prices where roughly 70% of the trading volume occurred. This is considered to be fair value for the market, meaning that most traders agreed that this price range was fair for trading. The value area is particularly important because it helps to identify areas where the market is most comfortable trading. Within the value area, we have two more levels called the value area high and the value area low. The value area high is like a ceiling, acting as a resistance level, while the value area low is like a floor, acting as a support level. When price moves above the value area high or below the value area low, it can mean that price is moving into an overbought or oversold area. Breakouts from these levels often signify a shift in market sentiment, and watching the volume that accompanies these moves is critical to determine if the breakout is strong or weak. It is also helpful to recognize how these levels relate to specific chart patterns. For instance, the value area high and value area low can often coincide with classic chart patterns like double tops and double bottoms. When price hits the value area high twice without breaking above, it can signal a double top pattern, suggesting a potential reversal. The same is true for the value area low and double bottoms, where repeated touches without a break lower could indicate a reversal to the upside. These areas act as strong reference points for recognizing reversals in real time. Furthermore, it is useful to keep an eye out for consolidation patterns that occur within the value area. Consolidation within this range indicates that price is in a period of balance, with neither buyers nor sellers gaining control. If price eventually breaks out of this consolidation, whether above the value area high or below the value area low, it often leads to a significant move in the direction of the breakout. Watching the volume during these consolidation phases can also provide clues as to the strength of the impending breakout. High volume during a consolidation phase often signals that a large number of participants are getting involved, which can lead to a strong breakout when the price finally moves. In addition, ascending triangles, descending triangles, and symmetrical triangles can also form around these key levels. Ascending triangles often show up when the value area high is being tested repeatedly while the lows continue to rise. This pattern suggests that buyers are gaining strength and preparing for a breakout. Similarly, a descending triangle can form when the value area low is tested multiple times, with lower highs putting pressure on the support level. Symmetrical triangles can occur when price is consolidating within the value area and a breakout is imminent in either direction. Watching the volume in these scenarios is key to confirming the likely breakout direction. Another interesting relationship involves the point of control. In a head and shoulders pattern, the point of control often aligns with the level of the head or shoulders, providing a key point where the price could react. If the price is attempting to break above the head but fails and falls back towards the point of control, it can be a strong signal that the trend is reversing. Inverse head and shoulders can also interact similarly, with the point of control acting as a critical level to watch for support. Continuation patterns like flags and pennants can be identified using the value area and volume nodes as well. When price breaks out of a flag or pennant near a high volume node, it indicates that there is strong support for the continuation. On the other hand, if the breakout occurs near a low volume node, the price may move quickly with less resistance. Recognizing where these patterns occur in relation to the point of control, value area high, and value area low can help traders determine the strength of the continuation. Understanding how these chart patterns align with the volume profile components provides a deeper perspective on market behavior. It allows traders to identify stronger setups and have greater confidence in their trades. It is also helpful to recognize how these levels relate to specific chart patterns. For instance, the value area high and value area low can often coincide with classic chart patterns like double tops and double bottoms. When price hits the value area high twice without breaking above, it can signal a double top pattern, suggesting a potential reversal. The same is true for the value area low and double bottoms, where repeated touches without a break lower could indicate a reversal to the upside. These areas act as strong reference points for recognizing reversals in real time. In addition, ascending triangles, descending triangles, and symmetrical triangles can also form around these key levels. Ascending triangles often show up when the value area high is being tested repeatedly while the lows continue to rise. This pattern suggests that buyers are gaining strength and preparing for a breakout. Similarly, a descending triangle can form when the value area low is tested multiple times, with lower highs putting pressure on the support level. Symmetrical triangles can occur when price is consolidating within the value area and a breakout is imminent in either direction. Watching the volume in these scenarios is key to confirming the likely breakout direction. Another interesting relationship involves the point of control. In a head and shoulders pattern, the point of control often aligns with the level of the head or shoulders, providing a key point where the price could react. If the price is attempting to break above the head but fails and falls back towards the point of control, it can be a strong signal that the trend is reversing. Inverse head and shoulders can also interact similarly, with the point of control acting as a critical level to watch for support. Continuation patterns like flags and pennants can be identified using the value area and volume nodes as well. When price breaks out of a flag or pennant near a high volume node, it indicates that there is strong support for the continuation. On the other hand, if the breakout occurs near a low volume node, the price may move quickly with less resistance. Recognizing where these patterns occur in relation to the point of control, value area high and value area low can help traders determine the strength of the continuation. Understanding how these chart patterns align with the volume profile components provides a deeper perspective on market behavior. It allows traders to identify stronger setups and have greater confidence in their trades. Next, let us talk about reading the volume profile visible range. This might sound complicated, but it is pretty simple once you break it down. We have something called high volume nodes, which are price levels where a lot of trading took place. These levels are strong areas of support and resistance because so many traders have taken positions there. If the price approaches one of these areas, there is a high chance it will react at that level. On the other side, we also have low volume nodes, which are areas where very little trading has happened. Price tends to move quickly through these low volume areas because there is less activity there. These are often places where breakouts happen, so when you spot price moving through a low volume area, it can be a good signal for a strong move. Let us now take a deeper look at how these high volume and low volume nodes interact with different chart patterns. When analyzing chart patterns like double tops and double bottoms, high volume nodes often serve as critical levels of resistance or support. For example, in a double top pattern, price may approach a high volume node twice but fail to break above it. This tells us that there is significant resistance at that level, and it strengthens the likelihood of a reversal. In a double bottom pattern, the price may test a support level twice at a high volume node, indicating that buyers are stepping in with strength, which suggests a potential reversal to the upside. Similarly, high volume nodes can add confidence when trading head and shoulders or inverse head and shoulders patterns. If the head of the pattern aligns with a high volume node, it provides an additional level of confirmation that a significant reversal could be in play. As the price moves towards the neckline, traders will often look for increased volume to confirm the breakout direction, and high volume nodes are an important part of this process. When price falls back towards the point of control or high volume node after forming a head and shoulders, it is a good indication that the trend may indeed be changing. Now let us move on to continuation patterns like flags and pennants. These small consolidations during a strong trend are usually opportunities for the trend to continue, but understanding the context of volume is crucial. If a flag or pennant forms near a high volume node, it suggests that the price is consolidating in an area where traders are actively accumulating positions, which increases the likelihood of a continuation in the direction of the prior trend. On the other hand, if the breakout from a flag or pennant occurs near a low volume node, it often results in a rapid price movement, since there is little resistance or support to stop the price from advancing. Triangles are another key pattern to understand when working with volume profiles. Ascending triangles indicate that buyers are gaining control as they push price higher against a consistent resistance level. If this resistance level is also at a high volume node, it can provide additional confidence for the breakout. Similarly, a descending triangle, which suggests that sellers are gaining control, can be validated if the support level is aligned with a high volume node. When a symmetrical triangle forms, it signals indecision in the market, and the breakout direction can often be predicted by observing whether price moves towards a high volume or low volume area. A break into a low volume node suggests a quick, potentially sharp movement, while a break towards a high volume node suggests the price may take longer, but with more stability. Finally, consolidation and accumulation patterns often align with high volume nodes within the value area. During consolidation, the price might bounce between high volume nodes, indicating that both buyers and sellers are positioning themselves for a larger move. Accumulation, characterized by a slow upward movement in price with steady volume, can indicate that larger market participants are getting ready for a bullish breakout. In both scenarios, being able to identify these high volume nodes helps you understand where price might break out and how strong that breakout could be. By thoroughly understanding how these high volume and low volume nodes interact with common chart patterns, traders can significantly improve their ability to identify meaningful support and resistance areas, as well as anticipate strong breakout and reversal opportunities. This deeper understanding adds a layer of analysis that can lead to more informed and confident trading decisions. Now, let us move into how we can use the volume profile to spot trading opportunities. One great opportunity comes with reversals. Reversals often happen at high volume nodes. When the price comes close to a high volume area and starts building up more volume, it is a good sign that a reversal might happen. You can watch for the price to stall or start to turn around at these high volume levels. Another key opportunity comes from breakouts. When price moves through a low volume area, it often does it with speed, as there is less resistance. This can be a great time to look for a breakout trade. When volume starts increasing, it confirms that the breakout is real and not just a fake move. Another really useful part of the volume profile is the point of control. Remember, the point of control is where the most trading activity happened. The interesting thing about the point of control is that price often returns to this level. You can think of it as a magnet for the price. If you are trading in a trending market, you can use the point of control to guide you for re-entering trades. In a range-bound market, it can be a point to watch for reversals. It also works well to confirm trends. If the price is consistently trading above the point of control in an uptrend or below it in a downtrend, it tells you that the trend is strong and likely to continue. Now let us look at a strategy for trading breakouts using the volume profile. Breakouts above the value area high are usually strong signals. When the price breaks above this level and you see increasing volume, it tells you that a strong move is happening. This is a great time to enter a trade in the direction of the breakout. However, remember to be cautious if the volume is low. Low volume can mean that the breakout is weak or that it might be a false move. Always look for confirmation with increasing volume before committing to a trade. We can also use the volume profile to find reversals. Reversals often happen at the value area boundaries. If the price reaches the value area high or the value area low and starts to reverse while volume increases, it is often a signal that the trend is shifting direction. This is a good opportunity to enter a trade after the price confirms the reversal. Also, watch for situations where price continues to move in one direction, but volume starts to drop. This means the trend might be getting weaker, and it could be a signal that a reversal is coming soon. In these situations, you might want to either exit your current trade or prepare to trade in the opposite direction. You can make the volume profile even more powerful by combining it with other indicators. For example, moving averages are great tools for confirming trends. If the price breaks above the value area high and the moving average is also pointing upwards, it is a stronger signal that the uptrend will continue. You can also use something called the relative strength index, which tells us whether the market is overbought or oversold. If price is near the value area high and the relative strength index is showing overbought, it might mean a reversal is about to happen. Another useful tool is the moving average convergence divergence, which shows us changes in momentum. If the moving average convergence divergence crosses up while the price breaks through a low volume area, it is a strong signal to enter the trade. Let us not forget about risk management. Whenever you trade breakouts or reversals, it is important to protect yourself from false signals. A good way to do this is by placing a stop loss just below the value area low if you are trading a breakout upwards, or just above the value area high if you are trading a breakout downwards. This way, if the breakout turns out to be false, you will not lose too much. Also, adjust your position size based on how strong the volume is. When trading near high volume nodes, it is safer to take larger positions, as these areas tend to be more stable with strong support or resistance. Near low volume areas, it is better to reduce your size because price tends to move more quickly and can be unpredictable. Low volume areas are often characterized by less trading activity, which means fewer market participants to absorb price movement, leading to higher volatility. In addition to using stop losses and adjusting position size, it is crucial to manage risk by diversifying your trades and not putting too much capital into any single position. Even the best-looking setups can fail, and it is important to spread out your risk so that one bad trade does not significantly impact your overall portfolio. Furthermore, always pay attention to the overall market context. If the broader market is trending strongly in one direction, individual breakouts or reversals may be more or less likely to succeed depending on that context. Another important aspect of risk management is using trailing stop losses, especially in trending markets. A trailing stop loss can help you lock in profits while still allowing for further gains as the trend continues. As the price moves in your favor, adjust your stop loss to follow the price, ensuring that you capture profits if the market suddenly reverses. This strategy can be particularly effective when trading breakouts from low volume areas where price movement can be rapid. Always remember that no trading strategy is foolproof. Practicing disciplined risk management will help you stay in the game longer and provide you with more opportunities to profit over time. The key is to protect your capital while maximizing the upside potential of each trade. Now let us go over a few common mistakes that traders make when using the volume profile. One big mistake is overlooking low volume areas. These areas are important because price can move very quickly through them. Do not ignore these opportunities. Another mistake is overtrading around the point of control. The price tends to move back and forth around this level without any clear direction, which can be confusing. Wait for a clear move before taking any trades. Lastly, do not rely on the volume profile alone. Always use other indicators to confirm your trades, like moving averages or the relative strength index, so that you can avoid false signals. To wrap it all up, the volume profile visible range is an advanced tool, but when used correctly, it can give you an edge in the market. Use it to find key levels like the point of control, the value area high, and the value area low. Combine it with other indicators to make your entries and exits more precise. Practice using the volume profile alongside your current strategy, and soon you will be able to spot quality trades with more confidence. Feel free to ask any questions or share your thoughts about what you find challenging. It is all part of the learning process, and discussing it can make it even more helpful for you.